There is a financial product where 50 to 70% of everything you pay in the first year goes directly to the person who convinced you to sign the contract. There is a product that costs roughly 10 times more than the alternative that does the same core job of protecting your family if you die. And there is a product that most of its own customers eventually abandon, with more than half of all buyers walking away within 10 years, many of them holding less money than they paid in. Here is the strange part. All three of those products are the same product. You would expect something like that to be illegal, or at least to be sold with a warning label the size of the contract itself. Instead, it is marketed as the responsible choice, the careful decision, the thing that serious parents buy to protect their children. It is called whole life insurance, and right now social media has dressed it up in a shiny new costume with a name that sounds like a cheat code, infinite banking. Today we are going to take it apart with numbers. One note before we start, because this topic touches real families and real contracts that people have already signed. This is education, not financial advice. I am not telling you what to buy or what to cancel. I am going to show you what the numbers say, and near the end I will explain why canceling in a hurry can be the worst move of all. Here is the pitch, and I want you to notice how good it sounds, because the people who deliver it rehearse it for a living. Term life insurance is renting. If you outlive the policy, you get nothing back, so every payment you made was wasted. Whole life is owning. You are protected for your entire life. It builds cash value you can borrow against, and it works as savings, investment, and protection inside one single product. Stop making the bank rich. Become your own bank. Every sentence in that pitch has been polished by decades of sales training, so let us walk through what actually happens after you sign your name. Start with the price, because the price is where the whole story begins. For the same payout when you die, a healthy 30-year-old might pay around $30 a month for a simple term policy or around $500 a month for whole life. That is roughly 10 times the cost for the same core protection during the years your family actually depends on you. One product is priced like a phone plan, the other is priced like a car payment. So where does all that extra money go in the early years? Here is the part the glossy brochure never explains. In the first year, somewhere between 50 and 70% of your premiums typically go to commissions and fees. You pay $500 a month, and through that entire first year, the majority of every payment never works for you at all because it is paying the person who sold you the contract. That is not a scandal someone had to uncover. It is simply how the product is built. And it explains the next number, which is the one that should make you sit up straight. Because so much money leaves in those early years, the cash value, the savings part you were promised, usually needs 10 to 15 years just to climb back to the amount you have paid in. Read that again. A product that is sold to you as a disciplined savings plan spends its entire first decade below zero. Then comes the question of growth, because even after the break-even point, the cash value does not grow the way a real investment grows. It typically compounds at around 2 to 3% a year, while over the same long stretches a boring, diversified stock portfolio has averaged around 7% a year. The distance between 3% and 7% looks small when you write it on paper, but compounded across 30 years, it decides almost everything about how your money story ends. Let us make it concrete with that same $500 a month. Option 1 is whole life. You pay $500 every month for 30 years, which adds up to $180,000. And at the end of those 3 decades, your cash value sits at roughly that same $180,000. 30 years of faithful payments, and the growth was eaten by the costs along the way. Option 2 is the boring path. You buy the $30 term policy, which gives your family the same death benefit while your children grow up, and you invest the remaining $470 every month in a cheap index fund earning 7%. After the same 30 years, that account holds around $570,000. Same monthly money, same protection during the years that matter most. One path ends with roughly 3 times the wealth of the other. But here is where this stops being a story about a bad deal and becomes something darker, because most buyers never even receive the bad deal. Researchers followed what actually happens to permanent life policies after people sign them, and the results are brutal. 29% of these policies are gone within the first 3 years. 57%, which is more than half, are gone within 10. Industry data from LIMRA points in the same direction, with around 12% of policies lapsing in the very first year and roughly 10% more in the second. Now hold those numbers next to the break-even point of 10 to 15 years, and you can see the trap close. The majority of buyers give up before the product ever climbs out of its hole. They pay the enormous early costs. They collect almost none of the later benefits, and they walk away with a fraction of what they put in. And the industry does not merely know this, it plans for it. 2 finance researchers at Wharton, Daniel Gottlieb and Kent Smetters, gave this business model a name that should end the argument on its own: lapse-based insurance. The product is priced with the expectation that huge numbers of customers will surrender early and forfeit money, and those abandoned contracts are part of how the mathematics works out for everyone else. The customers who quit subsidize the product. The house does not only win when you stay, the house wins extra when you leave. Which brings us to the new costume. Maybe you have seen the videos on TikTok, a confident man in a fitted polo shirt standing next to an SUV, explaining that wealthy people use a secret called infinite banking. Be your own bank. Borrow from yourself instead of paying a bank. Your money keeps growing even while you are using it. The idea comes from a book called Becoming Your Own Banker by Nelson Nash, published back in the year 2000, and social media turned it into a movement. Here is what infinite banking actually is once you remove the packaging: an overfunded whole life policy, combined with the ability to take loans against your own cash value. And notice that word, loans. When you bank on yourself, you are borrowing your own money and paying interest on it, and that interest goes to the insurance company. If the loan grows too large compared to the policy, the whole structure can collapse and leave you with a tax bill as a parting gift. So ask one question about every influencer who promotes this: how does this person get paid? A large share of them are insurance agents themselves, or they pass you along to one, and you already know the first number of this video, up to 70% of the first-year premium. That is not a conspiracy theory, that is a compensation structure. Now for the honest other side, because it exists, and skipping it would make me just another person selling you a clean and simple story. First, and most important, life insurance itself is not the scam. If anyone depends on your income, children, a partner, parents you support, then you need coverage right now. And cheap term insurance covering roughly 10 to 12 times your yearly income is one of the most responsible purchases an adult can make. The scam is not insurance. The scam is welding insurance to a weak investment and then selling the welded package as wisdom. Second, there is a real niche where permanent policies genuinely make sense. Think of people with estates large enough to face inheritance taxes, families arranging lifelong care for a dependent with a disability, or high earners who have already filled every tax-advantaged account and still have money left over. If that describes you, fine, but you also have an accountant, and you are not making this decision because of a short video on your phone. Third, there is an honest weakness in buy term and invest the difference, and the sales agents love to point at it. The strategy only works if you actually invest the difference. Plenty of people spend it instead. Whole life's one genuine virtue is that it forces you to save, because the bill arrives every month whether you feel motivated or not. But paying 50 to 70% of a first-year premium for forced discipline makes this the most expensive babysitter in finance, when a simple automatic transfer gives you the same discipline for free. So here is what you can actually do with all of this. First, keep insurance and investing in separate boxes for the rest of your life. Insurance is for protection, investments are for growth, and any product that promises to do both jobs at once is almost always doing both jobs badly while charging you twice. Second, if people depend on your income, get term coverage arranged this month, sized at roughly 10 to 12 times your yearly income for the years until the children are grown or the mortgage is gone. it will probably cost less than your streaming subscriptions. Third, take the difference you just saved and automate it on the same day every month straight into a broad and cheap index fund, so the money is invested before you ever get the chance to spend it. That single standing order is the entire secret behind the infinite banking videos without the 70% toll at the entrance. And fourth, this one really matters. If you already own a whole life policy, do not cancel it in anger tonight. The heaviest costs are already behind you, and depending on how old the policy is, keeping it can genuinely beat surrendering it. Take the contract to a fee-only advisor, meaning someone who charges a flat fee and earns nothing from selling you products, and run the numbers together before you touch anything. If you remember one line from this video, make it this one. A product that needs to pay a 50 to 70% commission to get sold is not being bought, it is being sold. More than half of the people who sign these contracts walk away before the product ever pays them back, and the pricing model has a specific place reserved for those families. They are the profit margin. The brochure calls them protected, the spreadsheet calls them revenue. If this video saved you, or someone you love, from a fitted polo shirt and a very confident pitch, subscribe, because next time we take apart another comfortable story, the money world keeps selling. And tell me below, has anyone ever tried to sell you whole life or infinite banking, and what was the exact line they used on you? I read every comment.